A rough week for the banking industry.
The collapse of Silicon Valley Bank.
The second biggest bank collapse in U.S. history.
Silicon Valley Bank is no more.
The storms on Wall Street continued today after regulators seized the assets of Silicon Valley Bank, marking the largest bank failure since the 2008 financial crisis.
Imagine you wake up one morning and check your bank account, only to find out that your life savings have disappeared. Sounds like a nightmare, right? Well, for many customers of Silicon Valley Bank, this nightmare became a harsh reality. The collapse of this once successful bank leaves many people uncertain about how to access their funds or what their financial future might hold. Today, we're diving into the topic of the collapse of Silicon Valley Bank, a major player in the world of the tech industry. While being invested with millions of dollars by companies such as Roblox and Roku, the Silicon Valley Bank suffered the second largest failure of a retail bank in United States history. The effects have been felt far and wide, causing anxiety among tech workers, raising concerns about the resilience of the banking sector, and causing Wall Street to grow in a panic as bank shares in the US plummet. But what led to this collapse? What does it mean for the future of tech financing and other companies who invested in Silicon Valley Bank? Join us as we explore the factors that played into the bank's collapse, the aftermath of the event, and the impact it has had on its customers. Lately, the collapse of Silicon Valley Bank has been making headlines and causing quite a stir in the banking industry. If you're not familiar with Silicon Valley Bank, it's a well-known bank that's been around since 1983 and used to be one of the biggest commercial banks in America, serving nearly half of all US venture-backed tech and life science companies. They even have operations in other countries like Canada, China, Denmark, Germany, Ireland, Israel, Sweden, and the UK. But unfortunately, it was not able to weather the storm of the recent economic conditions. Silicon Valley Bank boomed in the 2020 pandemic. This was made possible because of huge deposits of cash from its customers and low interest rates. With so much cash on hand, they had to find ways to invest the excess funds. They chose to invest in long-term US Treasury bonds, which are generally considered a safe investment as the US always pays back its borrowed money. However, as interest rates started to rise in 2023, the value of these long-term bonds plummeted. This caused Silicon Valley Bank to suffer significant investment losses, which they were unable to offset with new capital. Plus, you won't believe how quickly Silicon Valley Bank's operations collapsed. Only 48 hours. That's crazy, right? And to make matters worse, they had to sell all their bonds at a loss of $1.8 billion. But wait, it gets even worse. According to the FDIC, the bank had a whopping $209 billion in assets at the end of 2022. That's a lot of money. It's hard to imagine how things went so wrong for SVB in such a short amount of time. Anyway, let's take a closer look at some of the factors that led to the collapse of Silicon Valley Bank. But before we do, it's worth noting that the bank's failure is not just a concern for its depositors, but for the entire banking industry. As interest rates continue to rise, the value of banks' investment portfolios will likely continue to decline, increasing the overall risk for banks. With that in mind, let's explore some of the reasons why SVB went under. To put it simply, Silicon Valley Bank experienced a classic run on the bank, but the story behind its collapse is a bit more complicated. The bank faced several challenges that led to its downfall. First, the Federal Reserve constantly raised interest rates, which hurt tech stocks and caused long-term bonds to lose value. The Federal Reserve always seems to be hiking interest rates and printing excess amounts of money, which makes a lot of Americans very upset. This makes Americans upset because the Fed has many tools to combat inflation, but jumping interest rates seems to be the only thing they know when hard times come. SVB had invested heavily in the US Treasury bonds and was left with unrealized losses as customer withdrawals increased. On top of that, venture capital began drying up, forcing startups to withdraw funds held by SVB. One major problem with Silicon Valley Bank was the lack of diversification in the bank's portfolio. The bank was heavily invested in technology and life sciences, which are not immune to downturns in the economy. When these industries experienced a slowdown, SVB suffered. Finally, SVB relied too heavily on deposits to fund its operations. When the bank started experiencing losses on its investments and customers began to withdraw their deposits, it was unable to continue operating. Customer withdrawals were a total of $42 billion. These factors combined to create a perfect storm for SVB. Although the bank likely believed it was making the best decisions for its customers and shareholders, these decisions ultimately led to its collapse. It's worth noting that SVB is not the first bank to fail, and it won't be the last. Banks operate in a complex and ever-changing market, and sometimes they make mistakes. But SVB could have gotten more insight on the troubles they were doing if they had a chief risk officer. During the early stages of the crypto crisis caused by FTX, SVB was without a chief risk officer. This time only amounted to 8 months, but it is still a crucial position that should have been filled during an economic recession. However, it's important for banks to learn from these mistakes and make changes to their business practices to prevent future failures. In the aftermath of SVB's collapse, regulators will likely be closely examining the bank's operations to determine what went wrong and how to prevent similar failures in the future. It's possible that new regulations will be put in place to ensure banks are more diversified and less reliant on deposits. Now let's talk about what happened after the Silicon Valley Bank collapsed. The FDIC had to step in to protect depositors and take over all deposits and assets of the bank. To ease the minds of worried customers, the bank will reopen as a Deposit Insurance National Bank of Santa Clara. For depositors with insured deposits of $250,000 or less at SVB, they are already guaranteed that they will receive all of their money under the FDIC. Since the collapse of SVB, the FDIC has publicly announced that uninsured depositors will receive their money back as well, which furthermore cooled fears of contagion. The FDIC will issue a receiver's certificate for the uninsured amount of their deposits, and they'll receive some payment soon. All customers of SVB will be able to access their money when the bank reopens. This collapse also highlights the importance of deposit insurance. The FDIC's role in insuring deposits has been critical in protecting depositors from bank failures. Without the FDIC, depositors would have to bear the losses in the event of a bank failure. The FDIC's quick intervention in the case of SVB has helped to reassure depositors that their funds are safe, along with reassurance from President Joe Biden. The impact of the bank's failure is not just limited to individual customers, but also extends to startups and venture capitalists who relied on the bank for funding and other financial services. A startup boss who used the bank to pay his employees expressed concern for his staff and their financial security in the wake of the bank's collapse. As such, it is important for regulators and financial institutions to take steps to prevent similar failures from occurring in the future. Since the following days of SVB's collapse, many have openly come out and criticized former President Donald Trump and Congress. While he was in office, laws were removed from the Dodd-Frank Act. The Dodd-Frank Act was put in place after the 2008 economic crisis by former President Barack Obama. The purpose of the Dodd-Frank Act was to prevent a collapse like Silicon Valley Bank. When Trump and Congress removed some of the laws in the Dodd-Frank Act, small banks like SVB had rules that weren't strict compared to big banks such as Chase Bank or Bank of America. However, it is understandable that people are anxious about the situation, especially in the current economic climate. The COVID-19 pandemic had already caused a lot of financial stress and uncertainty, and the collapse of Silicon Valley Bank only adds to the overall sense of unease. It is important for people to stay informed about the situation and to take appropriate action to protect their finances. Customers of Silicon Valley Bank should follow the FDIC's instructions and withdraw their funds up to the insured limit of $250,000. It is also a good idea to stay in touch with the bank and keep abreast of any updates on the situation. That's all for now about the collapse of Silicon Valley Bank. Remember, it's always important to be aware of the risks involved when it comes to banking and investing. If you have any questions or concerns, don't hesitate to reach out to your financial institution or a trusted financial advisor. Thanks for watching, and I will see you soon.